Hey guys, as we get ready for earnings report this week, more companies are beating their earnings estimate than usual, and by a wider margin.
The S&P is now reporting the third highest earnings growth since Q2 2010. And so far, 56% of the companies in the S&P 500 have reported their earnings.
In this video, we'll walk through a quick recap of the Q3 earnings so far, and we'll take a look at key companies reporting in the week ahead.
Hey guys, it's Amber and Jared here from Holy City Family. We spent the last 15 years learning about personal finance, saving as much money as we possibly can, and investing in the stock market and real estate. We've been married for 9 years and we have 3 children under the age of 4 who we cherish deeply and love to the ends of this earth. They've actually changed our life more than they'll ever know and shown us what really is truly important in life.
Right.
Driven by that motivation, we became millionaires at the age of 35, and Jared just retired from his job, 9-to-5 job, at the age of 38. This year we also founded Holy City Family so that we can share our journey with you and share our tips, our tricks, and we hope that you guys can learn, save, and grow with us through that.
In a world where 58% of Americans have less than $1,000 saved and only 24% of millennials demonstrate basic financial literacy, we share content that teaches people how to save and invest their money. Our mission is to empower you to achieve financial independence so that you can pursue your dreams and ambitions in life. If it's your first time here, thank you for joining us.
Subscribe to our channel.
Please.
Subscribe to our channel. Say it, please. Say it, please.
Say bye-bye.
Bye-bye.
Before we jump into the upcoming earnings, let's take a quick look at the results so far. Okay, so this amazing yet a little complicated and overwhelming chart from Refinitiv was updated Friday, October 29th, 2021. So it's fresh and updated as much as it can possibly be. I wanted to walk you guys through it. The left side shows results for earnings. The right side shows results for revenue. The blended growth rates for the S&P 500 are 39.2%. And take a look at energy. It's 1,713%. My goodness. Is that broken? For revenues, these numbers are 15.1%, and energy is at a seemingly more normal 67%. For the scorecard, 82% of the companies reported earnings above estimates. 76% of companies reported revenue above estimates. Take a screenshot of this chart and take a closer look at it after the video, and check Refinitiv for, I think they were doing daily updates on this, so always make sure that you check the latest information. We'll also put a link to that in the description as well. Okay, now let's talk about the earnings report this week. Granted, there are over 160 different companies reporting, so there's no way that we could fit all that in one video. So we tried to pick out some key companies and also some companies that we have some background in and that we may or may not be investing in, and we want to break that down for you guys. So if you look at the calendar for this week, the schedule is on Monday. We have ON Semiconductors, PG&E, Trivago, and others to report. On Tuesday, we have some of our favorites like Pfizer, Corsair, Activision, and Zillow. On Wednesday, we have CVS, Discovery, Roku, Qualcomm, and Etsy. And on Thursday, we have Moderna, Regeneron, Nikola, Wayfair, Square, Pinterest, Uber, Airbnb, Peloton, Skyworks Solutions. Wow, Thursday's pretty packed. But there's a lot of great companies on there, so I wanted to make sure that I list that, and I think we should all be pay close attention on Thursday for those earnings. And then on Friday, you have companies like DraftKings, Goodyear, Groupon, Dominion Energy, and more.
So let's take at the earnings that are going to report on Monday. Our first one that we're going to kind of speak to is Clorox, but the Clorox company manufactures and markets consumer and professional products worldwide. Their earnings are forecast to grow 9.1% per year, and it actually pays a reliable dividend at about 2.85%.
And now for the snowflake analysis, you can see that the dividend is the high point. All the other areas seem a little bit on the low side. Financial health looks maybe average. Okay, let's take a look at Clorox and some of their product highlights. So as you can see here, Clorox owns a ton of different brands. Most of these we're probably familiar with. We've probably used these day in and day out. Consumer kind of defensive products, I would say. Okay, and let's take a look at Clorox in the 1-year chart. So as you can see in the past year, Clorox is down almost 22%, and you can see there's a pretty obvious downtrend that's been happening over the past year. Okay, so after taking a close look at Clorox, here's what we like. We like that they have a wide economic moat. We like that they have a 3% dividend. That's great. They sell consumer staples, which make us think it would be a fairly stable company.
And then what we don't like, so we don't like that there's a 775% debt to equity ratio. And there's also a negative 2% growth. And you can see that we showed before the current downtrend on that chart. That doesn't really fit well with us.
Yeah, we really need to see that thing turn around and start coming back up.
Now we're moving on to Tuesday. So Tuesday we're going to take a look at one of our favorite companies. Pfizer Inc. discovers, develops, manufactures, markets, distributes, and sells biopharmaceutical products worldwide. Its earnings have grown 86.3% over the past year, and it pays a high and reliable dividend of 3.57%.
So for the snowflake analysis, you can see that Pfizer looks pretty strong in the dividend, which we just mentioned. Right. Their financial health looks strong, and their past growth. Now on the value side, they're on the low. They're pretty low, and also future growth is quite low as well. Okay, let's talk about Pfizer and the product highlights. So as you can see, we highlighted Pfizer's focus areas, and those are internal medicine, rare disease, inflammation, and immunology, and then vaccines. Pfizer had actually invented the first, or developed the first COVID-19 vaccine. Okay, now let's look at Pfizer's 1-year chart. And as you can see, in the past year, they're up 31.16%, and they look like they have a pretty good little uptrend going that they're still on track with. What we like is the fact that they have a wide economic moat. They have 11% average growth. That's not great, but I think it's good enough. They have a 56% debt to equity ratio. Again, we wish that would be 40% or less, but not too bad. And they have a 10.27 forward PE ratio. That's great. And then they have a 4% dividend, which is also really nice.
And then what we don't like about Pfizer, there's a 253% 10-year return, and then it lacks a margin of safety. Make sure to subscribe to our channel.
Make sure to subscribe to our channel.
Now, another company that's reporting on Tuesday is Corsair. So Corsair Gaming Incorporated, together with its subsidiaries, designs, markets, and distributes gaming and streaming peripherals, components, and systems in the Americas, Europe, the Middle East, and Asia Pacific. Its earnings are forecast to grow 19.65% per year, and its earnings have grown 390.8% over the past year.
Wow. Now for the snowflake analysis, you can see that Corsair looks actually pretty good on the value side, on the past performance and financial health, and also on future growth. The only thing it's really lacking is a dividend, and that's typically not offered with a growth company like this.
So Corsair, you can see here, they've got a lot of products that they offer. I think it looks pretty cool.
Me too.
That would be awesome. But they actually make a variety of products for gaming and computers, like cases, keyboards, headsets, gaming PCs, cameras, mice, software, RAM, and a lot more.
Okay, now let's look at Corsair's 1-year chart. And as you can see in the past year, they're technically down 1%, not too bad, but overall just looking very flat. We've actually invested in this company and we've been scaling in, and we're really eager to see it bounce back. Right, seems like after the IPO, it started to take off, and then it's just been pretty much a downhill trend ever since. Now for Corsair, here's what we like and what we don't like. So for what we like, they have a narrow economic moat, not as good as a wide, but still, I think we'll take it. They have a 13 forward PE ratio, a 14% long-term growth, and a sufficient margin of safety. Like Amber was saying, I think at this point, the stock has fallen far enough below fair value that we feel comfortable investing in it for the long term. And
what we don't like, it has a 62% debt to equity ratio, which, like we said before, we really would like that 40% margin on that. They had a recent IPO, which it lacks historical financials. So I guess with the recent IPO,
it's tough with IPOs. You don't really know if it's what it's going to do moving forward, because you just don't have the history of years.
You don't have the 5-tier, the 10-year.
Yep, like other companies.
And then the competition.
Yeah, there's definitely competition out there. Right. I think it's doing well, but there's probably going to be future competition, and there's currently. So it's just something to keep your eye on.
So now we're taking a look at Wednesday and the earnings that we're going to report on that day. So the one that we're going to share with you guys is Discovery Inc. It's a media company that provides content across various distribution platforms in approximately 50 languages worldwide. Their earnings are forecast to grow 14.48% per year, and over the past 5 years, their earnings have grown 15.1% per year.
And now if we look at the snowflake analysis, you can see that the value looks great for Discovery. And also the financial health looks pretty good. A little weak on the future, no dividend, and in the past.
So here you can see that Discovery has a lot of variety throughout their TV channels and their content, such they've got Discovery, they've got HGTV, Food Network, TLC.
Okay, so next let's look at Discovery's 1-year chart. And as you can see in the past year, they gained almost 19%. But you can see this is kind of a scary looking chart. What we like is that it has a narrow economic moat. It has a sufficient margin of safety, like we said. We believe there's room to invest in this and have a little bit of room for error for the long term. They have a 9 forward PE ratio, which is great. They recently, as we mentioned, they started going directly to consumer with a streaming service similar to Disney Plus and that sort of thing. We also personally like a lot of the shows and a lot of the different stations that they have to offer, so it relates really well to us.
And now on the flip side, what we don't like. So we don't like that downtrend in that price that we talked about earlier.
No.
The 3% long-term growth, and then the negative 40% 6-month return. Another thing that we don't like is the 130% debt to equity ratio.
Right.
You can see on Thursday there's a ton that we share and that we really like and we've invested in, and it's on our watch list. So we want to share, just a couple breakdown, but we wish that we had all the time in the world to share everything with you guys. Take a look at this with Uber. Uber Technologies Incorporated develops and operates proprietary technology applications in the US, Canada, Latin America, Europe, the Middle East, Africa, and Asia Pacific. Its earnings are forecast to grow 66.22% per year.
Yeah, for the snowflake analysis, you can see that the financial health looks on the low side. Everything looks pretty low, honestly, except for the future growth, which is kind of cool. So the future looks bright for Uber.
With Uber, it was just Uber for a long time, and then Uber Eats came up, and then, there's probably going to be a ton more. And then you have Uber, the taxi type service, which you've used. I actually...
Oh, yeah, I've used it quite a bit.
I'm the one that hasn't.
You have not used it?
I've never used Uber.
Yeah, and with artificial intelligence and...
Like the self-driving cars.
Yeah, self-driving cars. They're a big player in that side. Okay, now for the 1-year chart. Uber in the past year is actually up almost 30%. And you can see by the chart, it's still somewhat flat, but there was an increase. I think they had a big drop right before that. So we are actively investing and scaling into Uber, and we do like the long-term outlook. Okay, like versus not. What we like is we really like the 35% long-term growth. 0.78 forward PEG ratio is nice. They also have a narrow economic moat, and like we said, they're very well positioned for autonomous driving and AI in the future.
What we don't like. 89.28 forward PE ratio, a negative 21% 6-month return. There have been a lot of lawsuits and government regulation, DD competitor in China and other countries, and it's also vulnerable to pandemics. Make sure to subscribe to our channel.
Make sure to subscribe to our channel.
So the next one on Thursday that's going to report is Peloton. Peloton Interactive Incorporated provides interactive fitness products in North America and internationally. Their earnings are forecast to grow 48.91% per year.
And as for the snowflake analysis, you can see that the future growth looks great. The financial health looks good. And then they're on the weak side, no dividend, a little weak on the value, and definitely on the past growth.
So here we're sharing some of the products that Peloton sells. It's really cool. Like it has the interactive screen. You have a coach that coaches you through whether it's biking or it's a separate workout off of the bike. So that's a really cool thing. It's not just the bike. It's weights. They have yoga workouts. They have all those instructors. And then there's another one, the competitor that we actually use is Beachbody, and Beachbody actually just partnered with Mix Fitness, and they do a bike too. So it'll be interesting to see the future of Peloton and Beachbody kind of competing on a similar platform.
There's also, I was reading this a couple weeks ago, but Amazon is also looking at doing a Prime bike. And I don't know the specifics exactly or the release date, but that's going to be trouble for Peloton too. Okay, so for the 1-year chart, Peloton is down almost 20% over the past year. And you can see in the chart they've been sort of on a downward trend, sort of flat. And similar to some of the others, we have been investing in Peloton, and we're just kind of waiting to see it get out of this dip.
Yeah.
Okay, so Peloton likes versus not. What we like is, and I did triple check this number because it's crazy, it's 231% long-term growth, and that's from Finbox. 0.15 forward peg ratio, which is great. And it's also, like we said earlier, well positioned during the pandemic and beyond. Almost oddly positioned, like right before the pandemic happened, that they had all this stuff ready, and it just seemed to take off like wildfire.
Right. And what we don't like about it, it has a negative 26% 1-year return, which we saw in the chart prior to. It says an 86% debt to equity ratio, and there's competition like Amazon, Nike, and Beachbody, like we mentioned before, and probably more as the years go on and as people continue to do more home workouts instead of gym workouts.
Yeah.
So here we are on the last day of the week, which is Friday, and you can see the ones that we've shared. So Groupon Incorporated operates in a marketplace that connects consumers to merchants. Its earnings are forecast to grow 52.72% per year, and it became profitable this year.
So as for the snowflake analysis, you can see that Groupon's looking kind of rough all the way around, except for the good news is that the future growth looks promising.
So we all know Groupon by now, I would assume that we all know Groupon, but you can use their website. You have it on your phone, on like a mobile device. And here is where you're able to go and search for coupons in your area and whatever area that you're in, whether it be for entertainment or food or like a spa or any of that. So it is a very interesting product.
Okay, if we look at the 1-year chart, you can see that Groupon over the past year is up 3.22%. It looked like they had a pretty big spike about 6 months ago, and then they've been kind of trending down ever since. Okay, so for the like versus not, what we do like about Groupon is the 14% long-term growth. That's not bad at all. They also have a sufficient margin of safety. If we were considering, if we like this company enough to invest in it, I would feel good about it long-term from that it has because it has a margin of safety, room for error if that were to happen. Also, we like that it has a 23 forward PE ratio and a 0.2 forward PEG ratio. So from a value perspective, this one looks good. We're just not really sure, like Amber will say, we're just not sure about the downside, and we're not sure if the upside is worth it.
What we don't like about Groupon, it has a 777% debt to equity ratio.
Yeah.
And then it has a negative 73% 5-year return. So those both are big hits against the company. Now that we've gone through some of the top earnings releases for this week, we hope this makes you a more successful investor as you progress towards financial freedom.
If you guys like this video, please give us a thumbs up and reach out to us in the comments below. You can also email us and follow us on Instagram. On Instagram, we're trying to get to 1,000 followers, and we're also trying to get more subscribers on this channel. We're trying to get to 1,000 on YouTube as well.
Yeah. Our goal is to read every comment and respond as often as we can. So make sure to subscribe to our channel below and join us as we learn, save, and grow together. Bye.
Bye, guys. Thanks.
Bye. Have a good day. Make sure to subscribe to our channel.
Wendy, can you blow kisses?
Get in my